While there are plenty of headlines that would have you convinced the market is in serious turmoil, the facts are very different if you're willing to zoom out and look at the bigger picture. In today's video, we examine the S word everyone has been trying to avoid and what it means for the future of the market and economy. Given the extreme events occurring right now, many are beginning to slip into a panic-laced mindset where market doom and selling everything looks more and more appealing. On one side, we have the market apocalypse, on the other, an alternative optimistic view that doesn't get as many clicks. We begin with some basic facts. Despite the headlines, it should be noted that the S&P 500 is up 12% over the past year and nearly 88% over the last 5 years. Those are incredible returns when you compare them to the 100-year average. Despite this, however, there is plenty to be worried about. YouTube is quick to kindly remind you that the troubles out there are serious, and many of the videos promoted by the algorithm are in fact true. For example, we do indeed have record high inflation closing in on 8% as of the most recent February report. This is a 40-year high, and to combat these issues, the Federal Reserve has publicly stated they intend to raise rates as much as 6 times this year alone. If this plays out as they note, the investing environment of the future will be significantly different than what we've been used to in the past decade. Our economy has not experienced something like this since the early 80s. At the end of the day, the ultimate question is how much will the Fed be able to raise the rate before the stock market begins to sputter and crash? There are plenty of people who believe the number is far lower than what is commonly accepted. For example, back in 2018, the Federal Reserve began to raise rates slowly for the first time since the 2008 recession. It did so until it reached about 2% in late 2018, and in a massive coincidence, the market posted its worst year since 2008. Featuring a drawdown that many have forgotten about. In total, the S&P fell 20%, which is far worse than what we're seeing today. It got so bad the Fed began lowering the rate back down to 1.5% in January of 2020, before conveniently a worldwide pandemic gave it the jumpstart necessary to suddenly lower rates back down to zero. What happened after? Well, the world's greatest bull run filled with massive speculation and epic tales of super profits. This event over those 2 years serves as proof that the Federal Reserve can only raise rates until about 1% before the market throws a fit. But unlike in 2018, in today's world, we have the added problem of severe inflation. This means that if the Fed can't raise the rate to a certain point to combat inflation, they are left with only one option, which is to keep the rate at zero while printing even more money to hold everyone afloat. Like I mentioned earlier, while we could do this in March of 2020, the same behavior today would only serve to worsen the already tragic situation with inflation. What everyone is afraid of is summarized in one term: stagflation. A situation in which inflation remains high, economic growth slows, and unemployment remains elevated. The potential for this event is perfectly summarized by Sven in his latest upload. Here's a small clip explaining exactly this. The full video I have linked in the description below.
This is now the key question here. Of course, the economy is strong while emphasizing the need for price stability. And the question here is, what if the Fed doesn't have the power to stabilize prices? What if they have to increase to 5%? Then we would have stagflation. So high inflationary pressures and a recession in the economy. And that's something very, very ugly and very difficult to get out of. And despite the confidence that Powell has, that is a risk from a monetary perspective. But later we'll discuss investing, and you'll see how, despite that, there are more important factors to consider when it comes to investing. And this is a nice comment that I found from Deutsche. The history of being able to guide inflation down from 40-year highs with maximum employment suggests a smooth landing is very, very difficult to achieve, said Matthew Luzzetti at Deutsche Bank. At some point, they will face the trade-off between pushing unemployment higher or accepting higher inflation. And that is a fact.
So basically what Sven is quoting there is Deutsche Bank's chief economist, who says Jerome Powell will soon face a difficult choice. He claims that a soft landing is close to impossible at this point. Essentially, in layman's terms, these financial conditions have left the chairman with few realistic options. His goal is to calm inflation by raising the rate gently enough not to induce a recession, but hard enough to prevent serious inflation. This is referred to as a soft landing. The problem, however, is that many experts are calling this out as an impossible objective. History tells us what is likely to come is stagflation. Like I mentioned earlier, our economy is not equipped to deal with big interest rates, and as the Fed moves to deter inflation, it's going to be quickly met with pressure to lower rates to improve a faltering market. As it stands right now, we are not there yet, but we're inching closer. This tweet by Meet Kevin showcases this exactly. In the late 70s, we had three key elements that created the infamous stagflation environment. One was unanchored and rising inflation expectations. Today we're seeing this number rise, but it's nowhere near the pace we were seeing in the late 70s, and if you zoom in on the tail, it seems that the expectations are flattening out. Second, we had high unemployment. The unemployment rate in 1979 was 6%, nearly double what it is today. Despite what we hear about the economy, the job market is still very healthy with the unemployment rate at near record lows. The commonality between the inflation of the 1970s and the inflation of today is the inflation number itself. But given the turbulent waters ahead, the two X's may be marked with a green check very soon. And our economy may begin to resemble the stagflationary catastrophe that was the 1970s, except this time, according to this user, we don't get the good music, substances, and everything else that made life fun. Ed Yardeni appeared on CNBC to argue the opposite. He claims that we're already in stagflation and the Federal Reserve has mostly lost control. Take a listen to his unique analysis. But before I show you the clip, make sure you hit that like and subscribe button if you're enjoying the content.
It's not inflation on the mind of our headliner today. It's a word that a lot of people don't like to use when you talk about all this. Ed Yardeni is the president of Yardeni Research, and it's the S word. The stagflation word. You really worried about that today?
I think we're in it. Before the war, we had a lot of data suggesting that we were experiencing an inflationary boom. Inflation was high, but at the same time, I think there was a widespread consensus, and I agreed with it, that we'd see peak inflation maybe by March or April, and then we would get back down, not to 2%, but maybe down to 3 to 4%. But now, as a result of the war and what's happened with commodity prices, we're clearly looking at higher inflation, and peak inflation isn't going to be for a while. And then the concerns, of course, is that we get more wage price spiral inflation. It's getting to be a little bit of a deja vu with the 1970s all over again. Since the war, I think stagflation is the scenario that's probably most descriptive of what we're starting to see and what we'll see in the next several months, which is higher inflation than we thought before the war and slower economic growth.
That would be Jay Powell's worst nightmare.
Yes and no. And in some ways, he's gotten a reprieve here because I think he can stay behind the curve, well behind the curve of inflation, and argue that there are extremely complex geopolitical circumstances which raise a lot of uncertainty. And so the Fed, I think, will raise interest rates, but will do it very, very gradually. And
whoever you believe, the truth is that nobody knows how this will play out, but what we do know is that Jerome Powell is in a tough situation that on its surface looks nearly impossible to solve. He needs to fix inflation and at the same time prevent a recession, but throughout history it's sadly true that the cure for inflation was always higher rates and a recession, giving up short-term pain for long-term comfort, with maybe the exception of the 1940s in which the economy was pushed forward by a different event. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.